Monetary reform is very important. That's really what I think we need to focus on in the world economy now. The Fed in the United States is given responsibility for monetary policy through our Constitution. Sometimes we think of rules or strategies, and this is a famous one, of course, the quantity equation. But you can see what this tells you. If money growth is up and velocity is not up and GDP is not up, then the only answer is inflation is up. So we go from doubling the rate of growth of the money supply from 4 to 8. Other things stay the same. Eventually, you have an increase in inflation, and that's what's being shown here. So this is one of the oldest rules which is around, but it's been replaced, not completely, but to some extent by this rule, which sometimes is called the Taylor rule, which focuses not so much on the money supply, but on the interest rate. So if you look at the one that's circled in red, it says the interest rate, maybe the federal funds rate, the short-term interest rate, should equal the inflation rate. So it's really effectively the real interest rate, plus a half times the GDP gap and a half times the difference between the inflation rate and its target. In this case, the target is 2, and then there's 2 as a measure of the real interest rate. So 2 is really what the target has been for many years at the Fed and other central banks. Other central banks have focused on this, but we're way above 2. Inflation is 6, 7, 8% in the United States and high, as we'll see in other countries as well. So this suggests the interest rate should be higher as a result. And so we can go on. This is a picture of how this rule was not good in bad times. It was good in good times. It was on in good times. And you can see the late 80s and 90s. And then it drifted away in the late period. We drifted away at the period, and that performance did not too well. And so the actual line, the policy rate was way below in that particular period. And then many people began to grasp on this difference. This is a quote from Janet Yellen when she was over at the Fed. When the economy is weak, we encourage spending by investing by pushing interest rates lower. When the economy is threatening to push inflation down the road, we increase rates. And she compared that with the so-called Taylor rule, which I just showed you a minute ago. And then there's other examples of this. You can see in the discussion, Jay Powell is referring to it. Larry Kudlow is a commentator, and others. He's never seen so much focus on rules, but it didn't last because of COVID. And we need to take this into account when we evaluate monetary policy. So everything changed when COVID hit. And there's the picture. The unemployment rate skyrocketed in the United States, went way up to nearly 15%. It's come back down below 4%, as you can see, so there's been a recovery, but we're still in a danger area. If you look at the world economy, the same kind of thing has happened. Not exactly as bad as the United States, but this is where the world looked in 2019. Looks pretty good. No reds, no declines, growth all over the place. But then the pandemic hit. 2020, red, and colors not so favorable, below 0, all over the place. And even China became light green. And then there was a recovery, which was good news. It affected every country in the same way, but we're on the way to a better performance if we play it right. And that's really what I want to focus on today. So if you now think about this situation, I showed you the unemployment rate going up and coming down. This is the inflation rate, just in the United States. And you can see it's increased quite a bit. It looks almost as bad as the 70s and 80s, but it's temporary in the sense it's not increased as much as fast, but it may last, and that's the danger. We need to address this issue. There's a headline, 8.5%, so just to remember that a lot of people are writing about this. It's not just charts. If you look at what's happened in the period since 2020, the Federal Reserve and other central banks focused more on rules, less on rules, and they're back to rules at this point, I think, for the most part. But the move to monetary rules was proceeding well until the pandemic hit. Then rules were out, but then they put them back in. And these are actually stipulations in the monetary policy report of the Fed. And so they put them out again in February of 2022. And Powell there was complaints from the Congress about this. He said, I'll put them back in. And he did put them back in. And they're in now. But there was only small changes in policy at least from the point of view compared to a rule, we still have an interest rate that's below 3% when it should be higher according to the rule. So in my sense, we are entering a period of high inflation continuing unless sensible monetary policy or actions are taken. Now, many things have occurred, and I'll come back to this. The situation in Ukraine has raised inflation, but it's not the basic story. It's distracting, and people pay attention to this, but that's really not the basic story of what's going on. We have to keep that in mind as we look at the situation. So when we look at the situation, we see this is Jay Powell, some testimony in the Hill, which he's being asked to do a lot. It just is just to summarize this. You can look at the slides later. But there are people who were noting there was a big discrepancy between the policy and the so-called Taylor rule. That's what the members of Congress were stipulating. And he said, he answered Bill Huizinga, don't worry, we'll have it back in the next one. He discussed it with French Hill. We'll bring them back for the July, and he did. He brought them back, but it was part of the system in the United States and in other countries where the monetary policy, there's kibitzing about the policy from different quarters. And this is actually a picture of the rules in the 2022 report just finished. And you can see there are 5 rules listed there. They're all a variant on the so-called Taylor rule, which is almost 30 years old at this point. It says the interest rate, just as I showed you a few minutes ago, should be higher for inflation as it is now. And so that's really what we want to focus on as much as possible. Now, let me just continue. I think it's good that rules are back in the monetary policy report, but they're not yet part of the strategy. I think that's what we have to focus on. And there's rationales for that, and you've heard this. Some of the rationale was the inflation rate was transitory. Don't worry, it was low in previous years. It'll go back again. It was supply chains, ships filling up in the harbor. Ukraine is mentioned, and there have been small changes, but policy rules are not the main factor of what's happening. There's thinking about how this is going to adjust, but it's not there yet. So this is the actions of the Fed. They raised rates. You can see over at the end there, they're most likely to raise rates by another 75 basis points in the next meeting. We'll see if they do. That's what the speculators are saying. But you can see they backed up almost to where they were before the panic began. And so that's in a direction I think is correct, but it's not sufficient by measures such as the Taylor rule. This is the money supply. It's grown tremendously. It's slowed down a little bit. So just take a look at that. It's increased a tremendous amount. That's the main message of this picture. M2 is the measure of the money supply in the United States. And this is the balance sheet. This is how much the Fed has purchased of assets like treasuries and mortgage-backed securities. It's diminishing to some extent and even coming down. And so this particular type of monetary policy seems over for the time being. And so the focus will be more on the interest rate. Now, finally, I think even if you add all this up, you still find the Fed is behind the curve. And we've had meetings about this and discussions about this. But if you just take the monetary policy report, which I've shown you, and you plug in the inflation rate, 4%, you plug in the gap between actual potential GDP minus 2, you assume the target is 2, that's really what it is, a real interest rate of 1, you still get an interest rate of 5%. So even with these situations, the Fed is way behind. And that's why people are saying it's probably going to raise it. I say 5%. We'll see if that does it. But even if we got to 2% by the end of this year, which doesn't look at all likely, you would say 3%. So 3% is still behind. And so that's the sense in which the Fed is still behind. You can see that the federal funds rate, FF, implied by the Taylor rule is much higher than the actual rate. And that's the difference that people are beginning to worry about. That higher stimulus to the economy is really what I think is behind the high inflation rate. Now, let me say this, it's important to make the adjustment, but I don't think the adjustment is the kind of thing which will be problematic. Clearly, the Secretary of the Treasury, Janet Yellen, says inflation is our top priority. We need to address it. She doesn't say explicitly a follow-up policy rule, but she did when she was the chair. No surprises, and going back to the international situation, each country should follow its own rule. Countries are not exactly the same, but many of them are off in the same way that the Fed is off at this point. The question as we look into the future is, are we going to continue with this situation of high inflation and the damage that could cause? Because we've seen in the past that could cause damage. And the answer is yes, unless policymakers make a change on the monetary side. And I think there are reasons for central banks to use these rules. They're not rocket science, but they come a lot closer. And if the central banks use known rules, and this Taylor rule or things like it are well known, then the interest rate would have to rise if inflation rises as it is now. Now, of course, all rules are contingent. If inflation comes down, we're okay, and it would reduce damaging changes later.